Disclaimer.
Yesterday, something happened in our financial markets that shouldn't be possible. Silver closed at $102.95 per ounce, a single-day surge of over 7% that shattered the psychological $100 barrier for the first time in human history. If you'd bought silver exactly 1 year ago on January 23rd, 2025, when it traded at just $30.58, you'd be sitting on gains of 236%. That's not a typo. In 12 months, this metal has more than tripled in value, while most of our neighbors were debating whether stocks would finally correct. But here's what should grab your attention. This isn't just another commodity rally that Wall Street will eventually tame with margin hikes and stern warnings about speculation. What's unfolding right now is a structural breakdown in one of the world's oldest pricing mechanisms, and the people who run our futures exchanges are watching their control slip away in real time. Let me show you what I mean. Pop quiz. What happens when traders who bought silver futures contracts for March delivery suddenly decide they can't wait 8 more weeks for their metal? Normally, they'd roll those contracts forward to a later month, accepting the small cost of waiting. That's how commodity futures have worked for over a century. But in early January 2026, something extraordinary started happening on the COMEX, our country's primary silver exchange in New York. Traders began rolling their contracts backward. Think about that for a moment. Instead of pushing their delivery dates into the future like normal market participants, they're demanding immediate delivery by rolling March contracts into January and February positions. This isn't how commodities traders behave when they're speculating on price movements. This is how people act when they know something the rest of the market hasn't figured out yet, that the metal they bought on paper might not actually exist in physical form when they come to collect it. And here's where the story gets uncomfortable for anyone who's been told our commodity markets are the most sophisticated and reliable in the world. The COMEX holds silver in 2 categories: registered inventory that's available for delivery against futures contracts, and eligible inventory that's stored in their vaults but not currently pledged for delivery. In the first 7 days of mid-January, according to TradingKey, the COMEX registered inventory collapsed by 33.45 million ounces. That's 26% of their deliverable silver vanishing in 1 week. Let me put that in perspective for you. Imagine your bank telling you that a quarter of all the cash in its vaults walked out the door in 7 days. And the people withdrawing it aren't panicked retail customers. There are other banks and institutions that suddenly don't trust the system anymore. That's essentially what's happening in our silver market right now, except the registered inventory has been bleeding for years. Since 2020, COMEX registered stocks have fallen by 70%. The pool of silver that's actually available to fulfill delivery obligations is now smaller than the outstanding claims against it. You might be wondering how this situation developed in the first place. After all, we've been told for decades that commodity futures markets exist precisely to prevent shortages by allowing producers and consumers to hedge their risks efficiently. The truth is more complicated, and understanding it requires looking at a fundamental flaw in how our paper silver market evolved. For years, the price of silver has been determined not by people who actually need the physical metal, electronics manufacturers, solar panel producers, medical device companies, but by financial institutions trading paper contracts that represent silver. Most of these contracts never result in physical delivery. They're settled in cash, with traders betting on price movements the same way someone might bet on a football game. The system worked reasonably well when paper trading volume stayed in proportion to physical supply, but over time, the amount of paper silver being traded grew to dwarf the actual metal backing those contracts. Think of it like this. If you and 9 friends write IOUs promising to deliver 1 silver bar each, but collectively, you only own 2 actual bars. The system functions fine as long as no more than 2 people demand delivery at the same time. The problem emerges when everyone shows up simultaneously asking for their metal. Suddenly, those IOUs aren't worth the paper they're printed on, and the people holding real silver can name their price. That's the situation crystallizing before our eyes in January 2026. The backward roll in futures contracts tells us that sophisticated traders, the kind who manage billions in commodity portfolios, have figured out that waiting is risky. Every week they delay taking delivery is another week the COMEX could change the rules, impose delivery restrictions, or simply fail to produce the metal. So they're paying a premium to move to the front of the line, and in doing so, they're forcing a reckoning that futures exchanges have spent decades trying to avoid. What makes this moment different from previous silver squeezes is the composition of buyers demanding physical delivery. This isn't primarily retail investors panic buying coins in bars, though that's certainly happening. According to the withdrawal patterns visible in COMEX data, large institutions are pulling metal from registered inventory. Entities that understand the market structure and recognize that the emperor has no clothes. When the professionals start heading for the exits, that's your signal that the game has fundamentally changed. The price action reflects this new reality. Silver didn't creep up gradually over the past year. It exploded in ways that defy traditional technical analysis. Breaking through the 1980 high of $50.36 per ounce was supposed to be the big psychological barrier, the level that had held for 45 years and marked the peak of the Hunt brothers' silver squeeze. Instead, silver blew through $50, then $60, then $70, barely pausing for breath. Each milestone that should have triggered profit-taking, and a correction instead became a launching pad for the next leg higher. This tells you something crucial about who's buying. When speculative traders dominate a market, you see volatile swings with sharp corrections as they take profits and reestablish positions. But when industrial users and institutions are buying because they need the physical metal or fear they won't be able to get it later, pullbacks are shallow and brief. They're not trading, they're accumulating. And they're willing to pay increasingly absurd prices because the alternative, not having silver when you need it for production or delivery obligations, is even more expensive. Yesterday's surge above $100 wasn't driven by retail FOMO or algorithm-driven momentum trading. According to real-time data from Trading Economics, COM, it came amid continued evidence that the paper market's ability to suppress physical prices is breaking down. The gap between what silver trades for on futures exchanges and what you'd actually pay to acquire physical metal has been widening for months, with premiums on coins and bars sometimes reaching 30% above spot price. That spread tells you the paper price is fiction, and the real price is whatever someone will pay to secure actual metal. And here's what keeps me up at night. We're still in the early stages of this crisis. The backward rolls in futures contracts, the inventory withdrawals, the parabolic price action, these are symptoms of a market transition from paper price discovery to physical price discovery. Once that transition completes, once the fiction that 100 paper claims can be satisfied by one physical ounce finally collapses, there's no historical precedent for where price could go. We'd be in uncharted territory, with industrial users bidding against each other for scarce supply, while our financial institutions scramble to figure out how to unwind positions they never expected to deliver against. The people running the COMEX understand this threat perfectly well. That's why you're starting to see desperate measures that would have been unthinkable just months ago. Margin requirement increases, subtle changes to delivery procedures, and very careful language in their public statements about inventory adequacy. They're trying to manage an orderly transition to a new reality without triggering the panic that could turn a squeeze into a crisis. But as those backward rolls demonstrate, the market is already voting with its feet. And what traders are saying is clear: show me the metal or I'm gone. Now let me show you the three forces that converge to create this perfect storm, because understanding what happened on New Year's Day 2026 in Shanghai will explain why everything changed overnight in ways most Americans still haven't grasped. On January 1st, China flipped a switch that fundamentally altered global silver markets. Their new export licensing system didn't just add bureaucratic red tape, it erected walls around the world's largest source of refined silver. According to reports from the South China Morning Post and multiple commodities analysts, the system requires exporters to demonstrate minimum annual production capacity of 80 metric tons just to qualify for a license. Think about what that means for a moment. If you're a mid-sized refiner producing 50 tons annually, you're suddenly locked out of international markets entirely, regardless of how efficiently you operate or how good your product quality is. The result? Somewhere between 60 and 70% of global silver exporters no longer have permission to sell their metal outside China. We're talking about effectively ring-fencing roughly 65% of the world's refined silver supply for domestic Chinese use only. The large state-approved firms that did receive licenses aren't rushing to export either. They are prioritizing domestic industrial customers who need silver for electronics manufacturing, solar panels, and the massive build-out of renewable energy infrastructure that Beijing has mandated. Here's how you know this policy is working exactly as China intended. The price divergence between Shanghai physical silver markets and our COMEX paper, silver has become absurd. While COMEX was still pricing silver contracts in the $30 to $35 range in late December 2025, according to data from AI Invest, COM and FX Street. COM, physical silver in Shanghai, was already trading above $80 per ounce. That's not a premium. That's a complete breakdown in price discovery. When physical metal in one market costs more than double the futures price in another market, what you're witnessing is the paper market losing its ability to set actual prices. The futures contracts have become theoretical constructs, increasingly disconnected from physical reality. You might wonder why China would deliberately constrain exports of a commodity they produce in abundance. The answer reveals something about how they are thinking strategically about the next decade of technology and energy infrastructure. Every electric vehicle battery, every solar panel array, every 5G network component, every advanced semiconductor, they all require silver for electrical conductivity. By restricting exports now, while global industrial demand is accelerating, China ensures their domestic manufacturers won't face supply constraints while foreign competitors scramble for metal. It's resource nationalism, and it's forcing the rest of the world to compete for a shrinking pool of available silver. The timing of China's export restrictions couldn't have been worse for Western markets, because just as Asian supply was being locked down, a completely unrelated geopolitical crisis emerged that supercharged safe haven demand for precious metals. On January 18th, President Trump escalated his ongoing dispute with European nations over Greenland by threatening tariffs on 8 European countries, 10% starting February 1st, with plans to raise them to 25% by June. According to Bloomberg's reporting, this wasn't just another round of trade saber-rattling. European officials began openly discussing the possibility of weaponizing their holdings of U.S. assets. We're talking about over $7 trillion in treasury bonds, equities, and other dollar-denominated investments. The dollar index plummeted to a 2-week low, dropping to 98.35 on January 23rd, according to bar chart data, down about 1% for the week. Now, you might think a 1% move sounds insignificant, but in currency markets, that's substantial. And more importantly, it signaled a shift in confidence. When European finance ministers start talking about reducing their dollar exposure and our own president is threatening our largest trading partners with escalating tariffs, international investors start asking themselves a very uncomfortable question. What if the dollar's status as the world's reserve currency isn't as unshakable as we've always assumed? This is where silver's unique properties become relevant. Unlike bonds or stocks, silver doesn't generate yield, it just sits there being metal. Under normal circumstances, that's a disadvantage compared to treasury bonds paying 4 or 5% annually. But when the dollar is weakening and geopolitical tensions are rising, that lack of yield stops being a bug and starts being a feature. You're not worried about earning interest when you're worried about preserving purchasing power against currency devaluation. The opportunity cost of holding silver, the income you're giving up by not investing in interest-bearing assets, essentially disappeared for international investors watching the dollar decline. So now you've got Chinese export restrictions choking off supply on one side, and geopolitical chaos driving safe haven demand on the other. But the third force creating this perfect storm is arguably the most powerful and the least understood by people outside specialized industries. The collision between artificial intelligence infrastructure build-out and the renewable energy transition, both of which are extraordinarily silver-intensive. Let me give you some numbers that should make you sit up straight. According to data compiled by First Goal Group, each 500 megawatt AI data center solar array requires approximately 300 metric tons of silver. Now, 300 tons might not sound like much until you realize we're building these data centers at an unprecedented pace. The International Energy Agency projects that global data center electricity demand will more than double from 340 terawatt hours in 2022 to over 700 terawatt hours by 2026. Goldman Sachs estimates that artificial intelligence alone will drive a 165% increase in power demand by 2030. Think about what's actually happening here. Every major tech company, Microsoft, Google, Amazon, Meta, is racing to build massive data center campuses to power their AI ambitions. These facilities consume staggering amounts of electricity, and increasingly, they're being paired with dedicated solar farms both to reduce operating costs and to meet corporate sustainability commitments. Every single one of those solar installations requires silver for the photovoltaic cells that convert sunlight into electricity. And there's no substitute material that matches silver's electrical conductivity and cost effectiveness at the scale we're talking about. The Silver Institute reported in December 2025 that solar photovoltaic demand for silver jumped 25% in 2024 to 230 million ounces, and they're projecting that figure could exceed 300 million ounces annually by 2030, according to mining.com's coverage. But here's what makes this demand fundamentally different from speculative or investment demand. Industrial users can't just decide to wait for lower prices. If you're Tesla building battery factories, or if you're a solar panel manufacturer with contracts to fulfill, you need silver regardless of what it costs. Your production line doesn't stop running because silver hit 100 instead of 30. You pay whatever the market demands, and you pass those costs along to your customers. This inelastic industrial demand creates a feedback loop that traditional commodity analysis struggles to model. When silver was primarily used for photography, jewelry, and silverware, demand could flex based on price. Kodak could reformulate film emulsions to use less silver, jewelry makers could reduce sterling content, and consumers could delay discretionary purchases. But you can't reformulate a solar cell to use 30% less silver without drastically reducing its efficiency. And efficiency is the whole point of solar power. The physics don't negotiate. What we're witnessing is 3 independent trends: Chinese resource nationalism, geopolitical dollar weakness, and industrial technology demand, intersecting at precisely the same moment. None of these forces was coordinated, yet they've combined to create a supply-demand mismatch that markets aren't equipped to resolve through normal price discovery mechanisms. And this brings us back to why the paper-silver system is breaking down so spectacularly. COMEX futures contracts assumed that industrial users would continue hedging their needs months or quarters in advance, giving the exchange time to source physical metal from producers and refiners around the world. But when China locks down 65% of global refined supply, when geopolitical tensions make international shipping less reliable, and when industrial demand is accelerating beyond anyone's forecasts from just 2 years ago, that whole system stops functioning. The buyers who actually need physical metal for production, can't afford to wait and hope that futures contracts will be honored. They're demanding immediate delivery, and they're willing to pay enormous premiums to secure it. This is why you're seeing that backward roll phenomenon I mentioned earlier. Traders moving from March contracts to January and February is not normal market behavior. It's panic. It's sophisticated market participants who have done the math and realize that waiting 8 weeks for delivery carries real risk that the metal won't be there when they come to collect. Better to pay the premium and take delivery now than to be left holding a cash-settled contract when you need physical silver for your manufacturing line. The divergence between Shanghai physical prices above $80 and COMEX paper prices in the 30s during late December perfectly illustrated this breakdown. Physical silver in Asia was already reflecting the true supply-demand balance. Too much demand chasing too little available supply, with Chinese export restrictions ensuring that Asian metal stayed in Asia. Meanwhile, Western paper markets were still pretending that futures contracts represented actual deliverable metal, maintaining prices that bore no relationship to physical reality. That fiction held until industrial users and institutions started demanding delivery in sufficient quantities. That COMEX registered inventory began collapsing at that dramatic 26% weekly rate. Here's what changed in January 2026 compared to previous silver rallies. The buyers aren't speculators betting on higher prices. They're manufacturers, solar companies, electronics firms, and institutions that have recognized the structural deficit and are securing supply before it becomes completely unavailable at any price. When the Hunt brothers tried to corner the silver market in 1980, exchanges could break the squeeze by changing margin requirements and restricting leveraged buying because the demand was financial, not physical. When silver rallied to $48 in 2011 on investment demand, similar interventions worked. But in 2026, raising margin requirements doesn't stop a solar panel manufacturer from needing silver to fulfill their contracts. The demand is real, it's industrial, and it's inelastic. That's why this situation is fundamentally different from anything our commodity exchanges have dealt with before, and it's why the mathematical inevitability of what comes next should concern anyone who understands how thinly traded physical silver markets really are beneath all that paper volume. Let me show you the math that makes what comes next virtually inevitable, because once you see these numbers, you will understand why this is not a bubble that is going to pop. It's a structural shortage that's going to intensify, according to comprehensive data compiled by TradingKey. COM and money metals. COM, the global silver market, has accumulated a cumulative deficit of 678 million ounces over the past 4 years. Now, to put that in perspective, total global mining production runs approximately 820 to 850 million ounces annually. What this means is that we've already consumed roughly 10 months' worth of total global mine supply from existing above-ground reserves. That silver didn't vanish. It went into industrial applications, solar panels, electronics, and other uses, where it's essentially unrecoverable at current prices. It's gone from the available supply pool. The year 2025 marked the 5th consecutive year of structural deficit in silver markets. SD Bullion estimated that deficit at approximately 295 million ounces, when you include investment demand through ETFs and physical purchases. 5 straight years of consuming more silver than we produce. That's not a temporary imbalance that corrects itself through normal market mechanisms. That's a fundamental mismatch between how much silver the world needs and how much the mining industry can deliver. Here's where the timeline gets urgent. At current consumption rates, the accessible inventory that is available for delivery against commercial contracts and industrial needs amounts to somewhere between 30 and 45 days of global supply. Think about what that means. If every mining operation in the world stopped producing tomorrow, we'd run through our available reserves in roughly 6 weeks. Obviously, mines won't stop producing, but this calculation shows you how thin the buffer has become between supply and shortage. We're operating on just-in-time inventory in a commodity that takes years to bring new production online. You can't just discover a silver deposit and start shipping metal 6 months later. Modern mining projects require environmental permits, infrastructure development, financing arrangements, and operational ramp-up that typically takes 5 to 7 years from discovery to meaningful production. The deficit we're experiencing now reflects underinvestment in mining exploration and development that dates back to the period after 2011, when silver crashed from 48 to eventually bottom around 12 in 2020. For most of that decade, silver prices were too low to justify major capital investment in new mines, and now we're paying the price for that underinvestment, with shortages emerging exactly when industrial demand is accelerating. What makes this mathematical problem unsolvable through traditional market mechanisms is that you can't create silver. You can print more dollars, you can manufacture more semiconductors, you can build more solar panels, but you can't conjure physical silver into existence faster than geological deposits allow for mining. The supply side is constrained by physics and geology, while the demand side is being driven by technology transitions and industrial needs that are not price sensitive in the normal sense. Now, the people running our futures exchanges understand this problem perfectly well. In fact, they're terrified of it, which is why you've seen increasingly desperate interventions over the past several months. The CME Group, which operates COMEX, raised margin requirements on silver futures contracts from $20,000 to $25,000 per contract for March 2026 positions, according to Financial Content. Com reporting, that's a 25% increase designed to make it more expensive for speculators to maintain leveraged positions. The theory is that by forcing traders to put up more cash as collateral, you'll shake out weak hands and moderate price increases. Here's the problem. That playbook worked in 2011, but it's failing in 2026, and the reason why tells you everything about what's different this time. In April and May of 2011, the CME raised margin requirements on silver futures 5 times in just 9 days. Each increase forced leveraged speculators to either put up more cash or close their positions, and the cumulative effect crushed silver from around 50 per ounce back down to the mid-30s within weeks. It was brutal and effective, and it taught futures exchanges that margin hikes are their ultimate weapon for controlling runaway commodity prices. But watch what happened when they tried the same strategy in late 2025 and early 2026. Margin requirements went up 25%. And instead of breaking the rally, silver blew through $100 for the first time in history. The exchange threw its best punch, and the market didn't even flinch. Why? Because the composition of buyers has fundamentally changed. When your contracts are held primarily by industrial users who need physical metal for production, or by institutions securing delivery for inventory, margin hikes just become a cost of doing business. These buyers aren't leveraged speculators gambling with borrowed money. They are manufacturers and asset managers who will pay whatever it costs to secure the metal they need. The exchange's failed intervention tells you something crucial. The CME is now protecting the clearinghouse from collapse, not attempting to control price. Every futures contract represents an obligation to deliver physical metal, and when registered inventory is falling by 26% per week, the exchange faces a nightmare scenario where they can't fulfill delivery obligations. Raising margins is their way of trying to discourage new contracts from being opened while they figure out how to manage existing ones. They're buying time, not restoring order. This brings us to the question everyone wants answered. How high can this go? Let me walk you through 3 phases based on the supply-demand dynamics and historical patterns. Phase 1 is where we are right now. Silver hit $103.45 on January 23rd, according to data from APMEX and JM Bullion, breaking above $100 for the first time and validating the 45-year breakout above that 1980 high of $50.36. We're currently in a consolidation phase where the market digests these gains and establishes $100 as a new floor rather than a ceiling. This phase is characterized by high volatility, continued inventory withdrawals from exchanges, and growing recognition among industrial users that they need to secure long-term supply contracts regardless of price. Phase 2, which I expect to materialize by the second quarter of 2026, targets a range of $130 to $150 per ounce. This phase emerges as China's export control system becomes fully operational, and Western industrial users realize that accessing Asian silver supply is no longer possible at any reasonable price. COMEX inventories will hit critically low levels. We're talking about registered stocks potentially falling below 50 million ounces, which represents less than 2 weeks of global industrial consumption. At that point, the premium for physical delivery over paper contracts will widen dramatically, and the paper price will be forced to catch up to physical reality. Users who've been hoping prices would moderate will capitulate and secure supply at whatever cost, driving the next leg higher. Phase 3 is where things get really interesting, and it's driven by a ratio that precious metals investors watch closely, the gold to silver ratio. Currently, according to data from Bullion Vault, COM and various precious metals dealers, that ratio sits around 50 to 1, meaning it takes 50 ounces of silver to buy 1 ounce of gold. Historically, that ratio has ranged anywhere from 15 to 1 at the low end, during periods when silver is relatively expensive compared to gold, up to 100 to 1 or higher when silver is cheap relative to gold. Here's the thought experiment. If gold continues its march toward $5,000 per ounce, which many conservative analysts now view as likely given currency debasement and geopolitical tensions, and if the gold-silver ratio compresses back toward its historical average of 20 to 1 or even 15 to 1, where does that put silver? At a 20 to 1 ratio with gold at $5,000, silver reaches $250 per ounce. At 15 to 1, you're looking at $333 per ounce. Now, I'm not predicting we'll see those extremes, but I'm showing you the mathematical possibilities if silver begins to be recognized not just as an industrial metal, but as a monetary metal in the way gold has traditionally been viewed. The more conservative Phase 3 target that I think is actually achievable focuses on $200 per ounce. And here's why that number has significance. When you adjust the 1980 silver peak of $49.45 for inflation, using standard CPI calculations, you arrive at approximately $194 to $200 in today's dollars, according to COMEX's inflation-adjusted analysis. In other words, if silver simply matched its previous inflation-adjusted high from 45 years ago, we're looking at a double from current prices. Given that the structural supply deficit is worse now than it was in 1980, that industrial demand is far higher, and that above-ground inventory is lower, reaching the inflation-adjusted 1980 high is not only possible, but could be viewed as conservative. Let me give you one more data point that should grab your attention. The London Bullion Market Association surveyed 26 professional analysts in late 2025 asking for their silver price forecasts for 2026. The average consensus prediction was $79.50 per ounce. As of January 21st, when silver hit $95.60, 9 of those 26 analysts had already seen their high-end targets exceeded. By January 23rd, when we broke $103, virtually every analyst's forecast had been blown through. The professional forecasting community, people whose entire careers depend on accurately predicting precious metals prices, completely missed how explosive this move would be. That tells you something important. Even the experts are consistently underestimating how severe this supply shortage has become. When professional analysts are wrong by 30% or more within weeks of publishing their forecasts, it suggests the underlying fundamentals are accelerating faster than traditional models can capture. These analysts have access to mining production data, industrial demand forecasts, and exchange inventory reports. They're not missing information. They're missing how those factors interact to create nonlinear outcomes. So where does this leave us as regular Americans trying to navigate these markets? First, understand that what you're witnessing is not market manipulation or irrational speculation. It's price discovery finally reflecting physical reality after years of being suppressed by paper markets that created the illusion of abundant supply. The paper-silver system worked reasonably well when it was primarily a tool for legitimate hedging and when physical supply could meet delivery demands. But when exchange-traded ounces outnumber physical ounces by factors of 100 to 1 or more, and when significant percentages of contract holders start demanding delivery simultaneously, the system breaks. That's what's happening now. Second, recognize that the 3 converging forces driving this rally, Chinese export restrictions, geopolitical instability weakening the dollar, and explosive industrial demand from AI and renewable energy, are not temporary phenomena that will reverse in coming months. China isn't going to suddenly open their silver exports back up, not when they need every ounce for their own industrial ambitions. The geopolitical tensions between the US and Europe over trade policy aren't going to magically resolve themselves. And the build-out of data centers and solar infrastructure is accelerating, not slowing down. These are structural tailwinds that will persist for years. Third, understand the opportunity cost of sitting on the sidelines. I'm not suggesting anyone should be reckless or invest more than they can afford to lose, but consider what happens to purchasing power. If silver does reach $150 or $200, while your savings sit in a bank account earning 4% interest. The dollar-denominated gains on silver over the past year have exceeded 230%. Even if silver consolidates and gives back some gains, the long-term trajectory is being driven by fundamentals that support substantially higher prices than where we are today. What we are watching unfold is a repricing event for a commodity that has been undervalued relative to its utility for decades. Silver has been trapped in the shadow of gold, treated as a poor cousin despite being essential to modern technology in ways gold never has been. You can't build an iPhone without silver. You can't manufacture solar panels without silver. You can't produce electric vehicles at scale without silver. And yet, until this year, silver was trading for less than what it cost in 1980, not even accounting for inflation. That mispricing is being corrected, and the correction is happening faster than anyone anticipated because the supply deficit is more severe than the market understood. The COMEX inventory collapse, The backward rolling of futures contracts, the failure of margin hikes to stop the rally. These aren't warning signs of an impending crash. They're confirmation that the paper market's control over price discovery is ending and physical market fundamentals are taking over. Once that transition completes, once the fiction that unlimited paper contracts can be satisfied by limited physical metal finally shatters completely, we'll discover what silver is actually worth in an economy where every aspect of technological progress depends on this one increasingly scarce metal. The professionals who manage billions in commodity portfolios have figured this out, which is why they're demanding delivery now rather than waiting. The industrial users who need silver for production have figured it out, which is why they're willing to pay premiums of 30% or more over spot price to secure physical metal. The question is whether regular Americans will figure it out before the easy entry points disappear, before physical premiums get so high that acquiring metal becomes prohibitively expensive, and before the gap between paper prices and physical reality becomes so wide that the exchanges are forced to implement delivery restrictions or cash settlement mandates. What happened yesterday when silver closed above 103 was not the climax of this story. It was the beginning of a new chapter where markets come to terms with scarcity in a commodity we've taken for granted for decades. The mathematical reality of 10 months of global production already consumed from inventory of 30 to 45 days of accessible supply, remaining of 5 consecutive years of structural deficits with industrial demand accelerating. That math does not resolve itself through wishful thinking or exchange interventions. It resolves through prices rising until demand destruction occurs or new supply comes online. And given how essential silver is to the technologies we're committed to deploying, demand destruction isn't really an option. So pay attention to what happens in the coming weeks and months. Watch whether COMEX registered inventory continues its collapse. Watch whether the backward rolling of contracts spreads to other months as more traders lose confidence in future delivery. Watch whether the premium for physical silver over paper contracts continues to widen. And most importantly, watch whether industrial users begin announcing supply constraints or production slowdowns because they can't secure the silver they need at any price. Those would be the signals that we're moving from phase 1 consolidation into phase 2 acceleration. The greatest silver rally since 1980 isn't over. It's just getting started. And unlike 1980, when the rally was driven by speculation that exchanges could break with rule changes, this rally is being driven by physics, geology, and the irreversible technology transitions our economy has committed to. You can't change those fundamentals with margin hikes. You can only adapt to the new reality that silver is no longer an abundant commodity we can take for granted. It's a strategic resource in structural deficit, and the price is only beginning to reflect that truth.